Hello everyone, this is Ray Reyes, President and Founder of MI Real Estate, and I am happy to be back with another multifamily investing update. It's been a few months since my last update and it feels like nothing has changed. We're still waiting to reach AC or after coronavirus. And things seem to have gotten a bit worse in many areas because a large swath of the population, here in the US at least, doesn't want to wear masks. Please wear your mask, folks. This is not about trampling on your rights. You're actually endangering others when you don't. On a lighter note, you're also endangering the start of the NFL's regular season, where my beloved Green Bay Packers are going to win it all. I'm a shareholder, by the way. On a good note, I was able to complete the final draft of my upcoming book, Bluff, the bottom line up front, passively investing in multifamily. It is now with the publisher for final considerations, edits before publishing. So excited about that. In addition, if you've been following my posts on social media, you likely saw my announcement that my partners and I recently closed on a 90-unit multifamily in Tampa, Florida. This is actually our second acquisition this year, and we're already looking at some potential additions, both here in Central Florida and in Atlanta, Georgia. All right, so being that we're stuck with COVID for a while, where does this leave multifamily investors? Like I said in my last update, I like multifamily because we all have to live somewhere, and multifamily investing has historically done relatively well during recessions. For more on this, take a look at my last update, which goes into details on this topic. So, if you invested in multifamily prior to this recession and were relatively conservative in your underwriting, also known as the valuation of the property, you shouldn't have much to worry about. Remember, we knew a recession was coming. It was a matter of when, not if it was coming at all. In addition, even if you weren't conservative, many lenders, especially if you're doing regular loans, were likely to force you into being more so. Having said that, there are some investors out there that in the exuberance of the moment bought property at too high a price point. Some of these properties did not qualify for long-term low-interest debt, also known as agency debt, and thus had to be purchased with a bridge loan, higher interest, shorter-term loans, with the expectation that they could qualify for better loans after repairs and increased occupancy. These investors will likely have to sell at a discount. Furthermore, some investors had properties for 8+ years and their loan is maturing in less than a year. They'll probably have to sell a discount as well because their projected price on their properties has likely gone down as cap rates have gone up. On the bright side, they will likely still have made very good returns. After all, before this recession, we were riding the longest economic expansion, which lasted over 10.5 years. So yes, we're in a recession, and they can be painful to many, but they can also be significant wealth building opportunities for multifamily investors that don't remain paralyzed on the sidelines. However, this doesn't mean there aren't pitfalls. As many of you know, real estate markets are local, and thus some will do better than others, just the way it is. With this in mind, my update today will focus on how to target multifamily markets. I will walk you through general targeting considerations and then add a few more to consider given the COVID-specific economic disruptions. But before I dig in, I ask that you take a moment right now and like and subscribe to this channel. And please send the link to others that may want additional information on this topic. Thank you very much. In this presentation, I will discuss target market selection. I will begin with what I like to call the bottom line up front, or a summary of the topic. I will then discuss what I like to call my big 3 minus R criteria, and finalize with some COVID-specific considerations. For each of these, I will point to some free resources that can help you with targeting. There are some paid resources that are actually better, but if you're just getting started, these will point you in the right direction, as we are looking for trends and not necessarily today's news or specific info on any property. Of note, my examples to demonstrate these concepts focus on greater Central Florida. This is not by accident. One, I live in Orlando. Two, and most importantly, I invest heavily in this area because, well, the long-term data supports it. I do want to stress that this presentation is for educational purposes only. Please do your own individual due diligence before making any investment decisions and consult with your own legal and tax professionals. And here we go. Let's start with the bottom line up front, or bluff. While conducting underwriting on individual properties is important, this should happen after you have selected target markets. It's generally best to narrow down your search to specific submarkets within a metropolitan statistical area, or MSA, or if in less populated areas, then you'd look at counties. This ensures your market is neither too broad nor too narrow. To select a target market, I focus on what I call the big 3 minus R criteria. I follow the people, jobs, and economy, and consider a market's risk, particularly a state or MSA's rent control policy and crime index. Finally, while industry diversification is important, it's also important to understand the impact of COVID-19 on specific industry sectors in the short to midterm. Resilient post-COVID-19 industries include IT, professional and business services, and financial services. Vulnerable industries include leisure and hospitality, which is not surprising, but also includes manufacturing, retail, and construction. The first key focus area in my big 3 minus R criteria is follow the people. So when I say follow the people, there are two important aspects: population and population growth. You want to pick markets that are big enough, generally a population of over 200,000, so that you have a good pool of interested buyers and renters. You will also want to focus on markets with above average population growth trends. A population decline may be an indicator that this is not a good market to invest in. Here's a map from the U.S. Census Bureau that shows at a macro level an overlay of numeric population change. You can get much finer detail at the U.S. Census Bureau's website, but this gives you a good idea of the concept. If you have certain markets in mind, you can also use Google, as you can see from this example. It will compare the search location with nearby locations as well. Ideally, you want to see positive trend lines for at least 5 years. Closely related to following the people is following the jobs. Specifically, you should look at the unemployment figures over the last 5 years for target markets you're interested in. There are several places to get employment data. One, the Federal Reserve Bank of St. Louis, or FRED. Here in this FRED chart, you can see Tampa's employment figures dating back to 1970. The FRED also overlays recessionary time periods in gray, which is helpful as well. Another place for employment data is the Department of Numbers. This website has more recent data and allows you to sort cities by several different categories. Citydata.com, and I'll refer to this website numerous times during this presentation, allows one to further zoom into employment figures, down to specific zip codes in this case. The data is just a bit older, but remember, you're looking for trends, not necessarily today's data. Citydata also lets you look at median income levels down to the zip code level. Understanding median income levels is important, especially when you start focusing on particular property classes. Ideally, you want to ensure that property locations closely match local median incomes and your target property class. What I mean is that you don't want a Class B property, for example, in a lower median income neighborhood. Very similar to how you don't want the best looking single family property on the block. If you want to learn a bit more about asset classes, please go to my blog at mirealestate.us/blog. I have a post there on key multifamily terms that will walk you through this and other important multifamily terminology. Analyzing the job diversity in a specific market goes hand in hand with analyzing the unemployment and job growth of an area. Overall, it's better to avoid cities and areas that are dominated by one or a few industries, particularly those industries heavily vulnerable to economic cycles. Florida Gulf Coast University's Regional Economic Research Institute gathers data from the Bureau of Labor Statistics to calculate an industry diversification index. With this state graph, one can see that Florida ranks in the top third of states, just below the average for the U.S. as a whole. Here's a graph with the index zooming in on a more granular level. As you can see, as of the fourth quarter of 2019, Tampa Bay is tops in the state. Other markets my partners and I track are not accidentally near the top of this chart as well. We'll talk a little bit more about economic diversification later in this presentation. And the last of the big three is follow the money or economy. You definitely want to focus on leading regional and local markets. As the saying goes, a rising tide lifts all boats. A good property in a location with a stagnant economy requires operational excellence or bargain basement pricing with a low margin for error. An average operator with a fairly priced property in a booming economy could perform just as well, if not better. This graphic from the Bureau of Economic Activity depicts real GDP change at the state level. Here's another graphic from the Bureau of Economic Activity. This one, as you can see, drills down to the county level. I've actually linked both the graphic and the raw data on the slide. Thus far, I focused on the big three: people, jobs, and economy. And I highlighted places where you can access that data to locate top and ascending target markets. However, an often overlooked data analytical point is risk. Policy-oriented risks include rent control initiatives, zoning regulations, permitting regulations, and supply restrictions in a market. Metros that restrict response to affordable housing demand are less likely to produce strong growth. Of these risks, I want to focus on rent control. And let me be clear. Rent control distorts the housing market by deterring and disincentivizing the development of rental housing and expediting the deterioration of existing housing. It is the combination of short-sighted policy-oriented issues which is at the root cause of this problem. In all actuality, it is in our best interest as multifamily investors to keep housing affordable in order to maintain high occupancy. However, we have to balance that affordability with paying the bills, the lender, other investors, our partners, and making a living, frankly. This is a snapshot of an interactive map on rentprep.com, which breaks down rent control laws by state, with links to legislation and media reports on active or rejected proposals. Opposite of most presentations, including many I gave and listened to when depicting the enemy or red forces in military presentations, the color red here is actually a good thing. These are states that preempt rent control. On their website, they also have legislation in list view, latest news on rent control in the USA, and links to further reading. Another risk that one should pay attention to is crime. Typically, there is a correlation between the criminal activity in a neighborhood and the delinquency rates of the renters living in that neighborhood. Fortunately, an easy search on the internet about the property and the surrounding area can let you know about recent crime activity and if there's anything to be worried about. Ideally, you want to look for target locations that have improving crime statistics over time. City data has good crime trend statistics. Here's a chart which shows the overall crime index for Tampa, Florida. Note the long-term downward trend, which is what you are looking for. City data actually lets you analyze crime down to the zip code level. And if you want to dig deeper, LexisNexis's community crime map can give highly granular data. However, it does not have coverage in some MSAs due to privacy laws. So you just have to take a look to see if your target markets are actually covered. So thus far, you've received general information that you can use to analyze markets in the mid to long term. However, since some investors are in and out of properties in shorter periods of time, It's also important to understand those critical short-term acquisition considerations. Here, I will focus on post-COVID considerations. Unison, a home co-investing company, published recent research highlighting job market resiliency as a way to predict the economic impact and the long-term effect of COVID-19. On this chart here, we are back to red being bad, by the way, and blue being good. As you can see, resilient industries include IT, professional and business services, and financial services. It's interesting to highlight that these industries suffered greatly during the Great Recession of 2008-2009. On the contrary, cities whose economies depend heavily on retail manufacturing, construction, and hospitality will experience slower recovery rates. Interestingly enough, these cyclical industries also suffered during the Great Recession. Of significance, education and health are expected to reverse and very quickly recover once we actually recover from COVID, whenever that is. Second, jobs associated with agriculture and related private wage and salary workers constitute a very small component of urban wages and have also been excluded from the analysis. Finally, the oil and gas sector has also come under severe pressure due to demand shock coinciding with the dissolution of the Organization of the Petroleum Exporting Countries Oil Supply Agreement. So you're probably saying to yourself, okay, this is good, but where is the data for my markets? You can get this data from the Bureau of Labor Statistics. Specifically, the data provides the number of jobs in a location and then breaks it down to a specific industry. Thus, knowing the total number of jobs in a location and the total number of jobs of a particular industry in that location, I was able to chart out the percentages of jobs in a particular industry within that location. I narrowed my search down to specific counties of interest in Florida, which are located in Orlando, Tampa, South Florida, Space Coast, Treasure Coast, and the Jacksonville MSA. I then compared these counties by industry with the DC and Las Vegas markets that the Unison report considered resilient in the former or vulnerable in the latter. For the sake of brevity, I depicted here leisure and hospitality industry percentages in those select Florida counties. To highlight the importance of narrowing down searches down to the county and submarket level, let's take a look at the Orlando counties of Orange, Osceola, and Seminole, highlighted in yellow on the chart. It's no surprise that the Orlando area theme parks have taken a beating due to COVID, and sadly, so have its employees, which are primarily lower wage earners. What may be a bit surprising is that the further north and east you go in the Orlando MSA, the less reliance on leisure and hospitality there is. In fact, Northeast Orlando has a growing IT sector and is the world leader in 3D simulations. It also has a more highly educated population due to the University of Central Florida, or UCF, which is located in Northeast Orange County, bordering Seminole County. At over 60,000 students, UCF has more students enrolled on campus than any other U.S. university. Some of the graduates actually travel to the Space Coast to work for NASA, SpaceX, and other aeronautical and or engineering companies. Furthermore, UCF has a College of Medicine and Health Sciences campus in Lake Nona, located in eastern Orange County. Lake Nona, dubbed Medical City, features Nemours Children's Hospital, MD Anderson Orlando's Cancer Research Institute, Orlando VA Medical Center, Burnham Institute for Medical Research's East Coast Campus, and a University of Florida research facility. That was a mouthful. So let's take a look at the Tampa MSA now. By far, the largest counties in the Tampa-St. Petersburg MSA are Hillsborough at 1.3 million and Pinellas County at 920,000 people. As you can see, Hillsborough County has a low percentage of leisure and hospitality jobs. In fact, Tampa The Tampa area is emerging as a top city in Florida for the IT industry. According to Tampa Bay Times in December 2019, the Tampa Bay area was named one of the nation's top 20 tech towns by the nonprofit Computing Technology Industry Association, thanks largely to its low cost of living and supply of tech jobs. According to the article, Tampa is now home to more than 150 tech startups, in addition to the University of South Florida, located in North Hillsborough County, which has over 50,000 students. Near the university sits a large cluster of medical biotech employers, including the Advent Health Tampa, VA Hospital, Shriners Healthcare for Children, the Moffitt Cancer Center and Research Institute. At 9.4%, Pinellas County is more dependent on leisure and hospitality, which makes sense given its large coastline boasting Clearwater Beach, one of the top beaches in America year over year. If you want additional information on these counties, on the other industries, feel free to contact me. I've got more info, but I just didn't want to put it all out there right in this presentation because it's already pretty long. So in summary, and I know this has been long, but hopefully it's been useful. Select target markets before target properties. Narrow down your search to specific submarkets or counties. Focus on the big 3 minus R criteria. And finally, understand the impact of COVID on specific industry sectors in the short to mid-term. I hope this has been educational for you, and at the very least is food for thought on the subject. As always, I am happy to discuss the subject further with you. Many minds usually think better than just one. I can be reached at my website, www.mirealestate.us. On it, you can find my social media information, so let's connect. You can also find other information that may be of use to you on my website blog. And please, don't forget to like this video, subscribe to the channel, and share it with others. There's a lot of work that goes into this, and it's just one way that you can help me out and that I can continue to provide, hopefully, what you think is educational content. So that's all for now. Please stay safe, and like always, invest where it makes sense.